Alright, this course clearly focuses on trading and in particular algorithmic trading for cryptocurrencies, but we will also briefly analyze long-term investments in cryptos. Now, trading and investing are two completely different things, and in this lecture I will highlight the major differences, but also some similarities of trading and investing. So, trading and investing are two different methods of attempting to profit in the financial markets. So, investors seek larger returns over an extended period through buying and holding, while traders, in contrast, take advantage of both rising and falling markets. And they also enter and exit positions over a shorter time frame. So they frequently trade and take smaller, more frequent profits. And we can also say that trading involves short-term active strategies, and the ultimate goal is to generate current income, so daily, monthly, or quarterly cash income. And in contrast to that, investing takes a long-term and typically passive approach. And the ultimate goal is saving and accumulating wealth for the retirement. Now, let me give you some examples for both methods and some buzzwords that you might have heard before. So for trading, some examples are high frequency trading, then also day trading, where traders buy and sell the instrument within a day and try to make profits on a daily basis. Then we have swing trading, then algorithmic trading, where traders create a trading bot. So the trader does not manually trade, and the computer does actually the trading. And finally, we also have copy trading, where a trader can benefit from a strategy of another trader. So these are just a few examples. And investing is all about portfolio investing or diversified investing. And typically high net worth individuals are getting advised by asset managers. And one of the more recent trends or services is robo-advising, where computers and algorithms create portfolios and make the investment decisions and not humans. And finally, we also have ETF trading. So that's the most comfortable way for retail investors. So they just buy exchange traded funds, which are typically highly diversified funds. Now let's continue with a more detailed comparison. And here we have some selected criteria. And the investment horizon for trading is short-term. So typically intraday, which is, for example, minutes or hours or few days or few weeks, while the investment horizon for long-term investing is, of course, long-term and can be between 2 and 50 years or even more. Now, the way how profits and income is generated slightly differs. So traders frequently buy and sell and realize trading gains. So they generate frequent cash income that they can reinvest in the next trades, while long-term investing is all about long-term growth and long-term wealth accumulation. So the value of stocks and funds in an investor's portfolio steadily increase over longer time periods. And the portfolio of long-term investors do not necessarily generate frequent cash. So a long-term investor typically receives dividend payments, and also some funds distribute profits, but generally a long-term investor needs to sell positions to generate significant cash. Now, coming to preferred asset classes, so traders and long-term investors typically are interested in different asset classes. So stocks and bonds and also real estate are great asset classes for long-term growth and wealth accumulation. And investors typically buy these assets and hold these for longer time periods. So this is clearly a typically passive buy and hold strategy. And in contrast to that, traders prefer asset classes that allow frequent active trading. And that means these asset classes must be highly liquid with low trading costs and high price volatility to benefit from price increases and also decreases. And Forex, So foreign exchange markets is the most liquid and active market, and most traders prefer Forex followed by cryptocurrencies. And cryptocurrencies are typically highly volatile, and there's a good chance to make large profits in a short time period, but also the risk to generate high losses. Now, traders actively trade these asset classes and take long and also short positions. So, with long positions, trader can take advantage of rising prices, and a short position allows traders to make profits with falling prices. So, traders can make profits in bull and also in bear markets, while long term investors typically have long positions only, benefiting from long term growth and price increases in stock and real estate markets. Now, long term investors typically have physical instruments in their portfolios. So, the stock or the bond issued by a company or a government or funds that invest in these physical instruments, while traders, in contrast to that, typically buy and sell derivatives of the underlying assets. So a forex trader typically doesn't trade physical currencies or commodities. He trades derivative instruments designed by a financial institution or a broker, and the value of these derivatives follow or are linked to the underlying asset. And there are actually some good reasons why traders prefer derivatives. So, derivative contracts are standardized contracts with high trading volume and low trading costs. And even more important, the derivatives simply allow to take long and also short positions. And they also allow to trade with leverage. So, trading with leverage, also called margin trading, allows to amplify gains but also losses. And in margin trading, traders use borrowed funds to trade instruments. So they don't pay the full price, but only a small fraction. And typically they borrow the rest from the broker. So this is highly risky. And the impact of leverage and how to do it right is one of the core contents of this course. And in contrast to that, the long-term investors typically don't work with leverage. And trading or transaction costs are typically low because they don't actively trade. However, asset manager fees and ETF fees are often underestimated. So these fees can eat up a high portion of the profit, while traders frequently trade. And controlling and limiting trading costs in trading is one factor of success, so one key factor in trading. Now, trading costs include commissions and even more important and often underestimated bid-ask spreads. Coming now to diversification, so long-term investing is all about diversification and portfolio investing. So a long-term investor's portfolio is highly diversified, while diversification is of less importance in trading. So successful traders nevertheless have several strategies and trade different instruments, but it's more important to create strategies that are profitable on a standalone basis. So typical trading strategies are based on technical and also fundamental analysis, and more and more important AI-based strategies, so with machine learning and deep learning. And finally, we also have statistical arbitrage. And there's a broad range of strategies for long-term investing. So from pure passive ETF investing to more specialized portfolio optimization strategies. And finally, to style investing, like large cap versus small cap, and value versus growth, and factor investing, and more. Finally, coming maybe to the most important aspects, return and risk. And a diversified portfolio typically generates 5 to 10% per year over longer time periods with low to moderate risk. And in contrast to that, the target return for traders is typically 10% per month. So that's at least the target or the desired return. And I don't want to say that it's simple or realistic, in particular for beginners, to generate 10% per month and more. But traders who generate 10% per month and more definitely know what they are doing, and they have the right skills to create good strategies and they also trade with high leverage. So they take high risks as well. So that's just the reality. No profits without taking risks. And sometimes a picture tells more than many words or numbers. And this is a typical chart here for trading. It's a candlestick chart. And a candlestick chart describes price movements of a security. And each bar or each candlestick stands here or shows the price movement or the performance in a certain time interval. And the time intervals can be 1 minute, 1 hour, 1 day, 1 month, or whatever. But typically in intraday trading, it's 1 minute or 5 minutes. And a green bar or a green candle indicates a price increase. So for example, from here to here in that time period. And a red bar indicates a price decrease from here to here. So traders typically work with candlestick charts and try to identify price patterns with moving average lines and more complex tools. So that's here trading at a glance. And this is a typical chart for investing. So in long-term investing, it's all about finding the right portfolio that either maximizes the return given a certain amount of risk or minimizing the risk given a target return. And diversification is the key to actually reach that target. So these are the major differences between trading and investing. But no matter if you trade or invest, decisions should be based on quantitative and data-driven analysis. So you need data like fundamental data or price and volume data. And traders and investors need to measure the performance and analyze risk and use optimization tools to improve and optimize the performance and to manage risk. And in particular in trading, backtesting and forward testing and also other simulation tools can definitely help to improve trading decisions and trading performance. And all these things require an appropriate knowledge and skill set to create systematic and profitable strategies that are definable and unambiguous. So trades and investments should follow a systematic strategy or a systematic idea. And this means that traders should be able to write down a rule, an algorithm, or a formula. And as a side note, also self-learning algorithms like machine learning or deep learning algorithms are clearly definable. So they can be a black box inside, but nevertheless they can be documented and defined as well. And once you have defined a strategy, you should be able to test how the strategy would have performed in the past. So you should be able to measure and quantify the performance of a strategy for any period and for any instrument. And typically a strategy that meets the first 2 points here is also reproducible. So with the right documentation, any trader can reproduce the strategy for any time period and for any instrument. Now, it's important to mention here that the trading and investment decisions that are primarily based on gut feeling and or intuition do not meet the above criteria. And I don't want to say here that you can't make profits with that approach, but you will definitely increase your chances if you have a clear plan and the skills and resources to execute that plan. And at least you should have somebody who has the plan and the skills. So for example, if you passively invest in ETFs, then you can benefit from the skills and the resources of those managers. But of course, it's best to build your own skills here. And that's exactly the plan for the next lectures and sections of this course. So building the skills for successful trading. Thanks for watching and see you there. Bye.